Hey there, and welcome to the Financial News Podcast. It's November 3rd, and this is your Monday morning financial market recap. The last 48 hours have been a whirlwind, capping off a big week for the markets. Today, we're diving into four top stories, moving stocks, bonds, and real estate, and what they could mean for your money. We've got news from the Fed, a major tech earnings surprise, real estate buyer action, and the lingering impact of the government shutdown. So let's jump right in. First up, let's talk about the Federal Reserve. The big news from last week, which is still ripping through the markets, is the Fed's decision to cut the federal funds rate by 25 basis points, which was a move that was widely anticipated. However, the key market moving element, which was a headwind, came from Chair Powell's subsequent comments where he signaled that, and this is from Reuters, a December rate cut is, and I quote, not a foregone conclusion, suggesting different opinions from Fed officials on the path forward. This injection of uncertainty has since caused a mixed reaction in the bond market, keeping Treasury yields from falling as fast as many had hoped, and therefore keeping the cost of borrowing from falling as well. The uncertainty means that the bond market is still trying to price in a future path of interest rates, leading to some choppiness in bond prices. Next, we look at corporate earnings, specifically in the tech sector, which is still a massive driver of the broader stock market. The surprise, while companies like Alphabet, Amazon, Apple, and Microsoft all reported very strong quarterly earnings results, largely fueled by growth in AI and cloud computing, one of the Magnificent Seven experienced a significant drag, which was Meta. According to Morningstar, they declined over 12% in the past week, recordedly due to a $15 billion tax charge attributed to a new tax act, as well as investor concern over the planned level of spending on AI investments. So even in a strong earnings season, the market is still tough on forward guidance and unexpected liabilities, punishing even the largest, strongest players if their spending plans or tax impacts are seen as a risk. Shifting to the real estate market, we're seeing an interesting trend emerge following the recent Fed rate cut. The good news is the Fed's cut has helped keep pressure off mortgage rates. According to Freddie Mac, the average 30-year fixed-rate mortgage fell for the fourth consecutive week and landed around 6.17% for the week ending October 30th. For buyers, this signals a reprieve in rates, which are still historically high, and has been encouraging a specific type of borrowing, which is adjustable rate mortgages, or ARMs, something we saw back in the financial crisis. According to the Mortgage Bankers Association, ARMs made up about 10% of all mortgage applications in September, the highest level in nearly 2 years, as borrowers look for a lower starting rate on ARM offers. I think buyers are betting that rates will continue to fall in the coming years, making ARM mortgages an attractive way to save money now in the hopes of refinancing into a lower fixed rate later. And finally, a factor that continues to influence all markets is the ongoing protracted US government shutdown. So now in its fifth week, the shutdown has delayed the release of crucial economic data, things like jobs numbers, GDP, the personal consumption expenditures, or PCE inflation index. According to the Business Times and Penn Mutual Asset Management, while the stock market has remained surprisingly resilient so far, economists warn that the lack of timely, reliable data could begin to affect investor confidence and make the Fed's job much harder as they're trying to anticipate where to go with things. When the central bank lacks key metrics, its decision-making process becomes cloudier, which can lead to greater market volatility. In anticipation of this week, investors will be focused on any non-government reports like private sector ADP employment report and the ISM manufacturing index, and try to fill the data, basically try to fill the data void. So to wrap up, markets are navigating mixed signals from a hawkish Fed and mixed tech earnings. Meanwhile, the housing market is seeing buyers turn to ARMs to cope with higher rates, all while the government shutdown keeps the whole economy guessing by withholding critical data. It's definitely a time to be paying attention. Thanks for tuning in to the Financial Market Breakdown today. If you found this helpful, hit that like button, subscribe for more market updates, and let me know in the comments which of the stories you liked the most and which you think have a big impact this week. And be sure to check out the disclaimer in the video description. Thanks, and we'll see you next time.